Welcome, everyone. I'm Mike Bershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast. I'm your host, Mike Bershazadeh.
And I'm Ashley Ward.
And today we have Jonathan Smith. Jonathan Smith is a co-founder, CEO, and chief investment officer at DT Investment Partners, LLC. He is responsible for establishing DT Investment Partners' long-term strategic asset allocation benchmarks based on proprietary optimization procedures. John uses this optimization as well as other core consulting techniques to lead DT's high net worth consulting practice. He also assists in implementing client asset allocation strategies and directs and monitors the company's investment philosophy, process, and approach.
John, with your extensive experience and leadership roles in investment management, we're eager to hear your insights into the industry today. Thanks so much for joining us.
Thanks for having me. I appreciate it, both of you.
Well, let's dive right in. So, John, let's start by exploring your unique journey in the investment management industry. Can you share with us a little bit about your origin story and your experiences that led you to now your current position at DT Investment Partners?
Sure. My background, I started out actually not having much of a background in finance, started out in healthcare, did a total 180, went to Wharton for my M.B.A. and started really getting intrigued by asset management. Went into the investment management securities practice, worked there for a number of years, helping to improve operational processes and firms, and then got into fixed income research, and really that's where everything sort of continued to grow. And then eventually was the chief investment officer for fixed income at a trust company in the area. Where we were doing active management, finding yield curve positioning, overweighting a number of different asset classes to try and outperform fixed income benchmarks. And the origin for DT Investment Partners was I was working there on the fixed income side with a number of other people that eventually came over with us. And we always just sort of said to ourselves, we understand the fixed income arena and how to outperform, but like many trust companies, they had a 40 large cap stock portfolio trying to outperform the S&P 500, which almost never happens. And I just never understood why people would try and overweight and underweight different securities to try and outperform the benchmark. But then with the advent of exchange-traded funds and index funds, it allowed us to take care of sort of the risk side of the asset allocation. We created an asset allocation process and said, let's take a number of people here that we had at this trust company and try and start it on our own. We started out with a seed investment of $67 million in assets to manage, and 16 years later, we're approaching $2.4 billion. So
Wow.
It's just been a slow grind, but the asset allocation ETFs, like I said, allowed us to really attack the risk side in addition to the fixed income side.
Wow. So you guys started, 16 years ago?
Yes, August of 2008, believe it or not.
Oh, my God.
I also didn't have any assets, right? I mean, we didn't have revenue, we didn't have any assets. So it was sort of ready to go with that. That's really a challenging environment.
So you said you guys have grown your AUM now to use a 2.6?
2.4 billion. Yeah.
Wow. Good for you guys. That's phenomenal. How have you done that growth? Was that through all organic growth, some inorganic growth?
Yeah, I mean, so, on some of the questions on that, in terms of entrepreneurialness or whatever, I think it's key, and what we did in the beginning is to say we have one unified mission in our front. What's that unified mission going to be? And for us, it was about portfolio efficiency versus the ugly, security selectors, because, some studies have just shown that you can't beat a benchmark on a consistent basis with security selection, and it costs a lot of money to do that. And so we wanted to focus on portfolio efficiency. And so we created this asset allocation model across a number of different risk tolerances, and we use that in any way possible, no matter what the client was. So if we had a direct person. We would do that. We would implement asset allocation, do planning, and do the standard things that a normal advisor would do. Uh, Secondly, for distribution people, like sort of we tried to give an institutional type of investment process to the retail investor that we didn't really think, had the choice of that up till now. And so, there are distribution people out there who were very good at relationship management and having clients, but didn't really know how to manage money. So another part of the business is sub-advisory. So we will manage money sort of on a private label basis on the back end, and then they can manage the client relationship. And it's much more profitable for them because we take a low asset-based fee. And then the third arena where we really used how we analyze portfolios from an asset allocation, from a fee perspective. What's the performance history been? If they're with another advisor, we'll do a portfolio review for them, sort of give us a brokerage statement, we'll analyze everything about that. But that led us into ultra high net worth consulting, where you have ultra high net worth families that have relationships with trust companies or whatever that they can't really get out of, but they don't really know what's going on. So, for a retainer-based fee, we would be sort of their advocate and the eyes and ears and look at the quarterly returns. If they're suggesting to use private equity or different things, we'll do that analysis and they'll get a totally unbiased, independent view. So the clear asset allocation and portfolio efficiency has led us to these three sort of distinct revenue streams.
Wow. And how many total advisors do you guys have?
How many employees? You mean client-facing people here?
Client-facing.
We have three. Yeah, we are a lean organization, and if you think about it, that advisory channel where we're managing money, really the advisors at the front, and we're just managing the money on the back ends through sort of a sub-advisory dual contract basis. So it makes it so that we don't need to quite have as many distribution people as a lot of other organizations. We have 10 total employees here.
Wow. And so how much of the money that you manage is sub-advisory as opposed to clients that are directly under your guys?
I'd say our asset mix is a third sub-advisory, a third direct. It's considered a consulting, a third to be almost direct as well, because a lot of times, we're overseeing someone else, a broker that might be managing our relationship. And eventually we show them sort of an index portfolio versus all the stuff that's going on in that portfolio. And sometimes they just see that the index strategy is doing so much better that they say, well, we want you guys to, just run an index strategy. Again, it's not really us taking over management. It's us implementing asset allocation. Or if they have fixed income mutual funds, we believe it's much better to have an individually managed individual municipal bond or taxable bond portfolio. So we'll take that over. We'll do it for obviously a much lower fee than they're currently doing it. So it leads, all of these channels leads different places. It's just each one of them has taken a long time to sort of cultivate. But now I think an asset management firm, it takes a long time for them to mature, people to start taking you seriously and believing you're going to be around for the long run.
Wow. And so with in the last 16 years, the individuals that had started with you in the organization, had they gotten the opportunity to become owners as well, and equity partners as well in the organization with you? Guys?
At this point, we have three current partners, and they were the three partners that came over initially. It was really three of us that came over initially. I mean, obviously, we're young, but we're getting older, but we are starting to bring on sort of that next generation of personnel that are now in their 30s that really understand what it takes to make this successful. And obviously, that's sort of our succession planning, with so much consolidation going on right now. I think continuing to stay sort of one of the few independents that's not affiliated with a broker dealer, that's not backed by a private equity company, that's a real differentiator, and I don't ever want to lose that.
Really cool. And what's your opinion on what's going on in the marketplace right now with a lot of the private equity moving into the space and almost this is the way kind of you saw the way it was 40 years ago, where there was, it wasn't private equity, it was the Goldman Sachs and the Barclays and those guys,
Right.
and then there's just very few individual RIAs. Do you think it's going back there, or do you think that?
I think I think private equity struggles. They have a lot of dollars, and they're all fighting for different investments, which has led them to asset management. I don't know why they've, sort of gone against asset management for so long, but now they see this annuity stream business, and it's what's made this massive consolidation happening. And there's a lot more consolidation that can happen and will happen. I think there's just going to, the old United Asset Management. I mean, really, that's what private equity is coming and doing. There's I can't tell you how many calls we've gotten over the last 3 years with private equity companies. But those calls usually last 45 minutes. It's a quick, hey, these people looking to get out, get some money, and then they're going to stick it along with someone else. Because when we talk to them, like we said, there's not many individual brain managers left. And a lot of these consolidators, all the advisors are using mutual funds for fixed income, and they're outsourcing that revenue. I always thought if you wanted to come on and have it be a strategic initiative, well, then let us manage the fixed income, and all that outsourced revenue, they're using mutual funds and everything. Let's face it, fixed income mutual fund is at a loss right now, so there's no capital gains implications. We manage that, and then all of a sudden you get all this revenue that comes in. It just seems like they're putting pieces together, but they're doing it just to aggregate assets, aggregate revenue, and then probably sell it off to the next bigger private equity.
Yeah, I get what you're saying there. And why do you think? And do you think why do you think that this became something that's been more popular over the last few years, right?
I just think it's because it's an annuity stream business, and a lot of firms a lot of industries that they've targeted haven't necessarily had this recurring revenue stream that asset management does. And quite frankly, if they're taking over something that has an insurance component in addition to the asset management component, I think some of the fiercest salespeople are in the insurance business, and I just think they're going to continue to have a good revenue stream from it, and it's going to be a good, stable revenue source for them. And if they put enough of them together, it's going to give them an exit strategy. I mean, most, real estate, a lot of these industries that they've attacked, they've had a hard time getting exit strategies. It's
Right.
really easy in the investment business is getting an exit with a bigger firm, show that revenue that's recurring, and it's all very liquid. So yeah, that's what I think.
And do you think it's with the baby boomer era, and with the amount of advisors that are reaching, the average age is around close to 60 now.
Yeah.
Last time I checked. And what you think with the amount of projected advisors that are going to be retiring, or owners of RIAs that are going to be retiring that may not have a G2 lined up, do you think that's pushing private equity into the space as well?
Yeah, it's hard to say, because I think a lot of those advisors that you're talking about are at brokerage houses, and I think it's difficult for them to break away, then establish an RIA over 5 years. They just, most of those people actually die at their desk. I mean, they don't have an exit strategy. They're going to take the last bit of revenue that they can. It's the only way that they know it. And then you have advisors that are affiliated with LPL and different firms, and they're sort of locked in there. And you have a lot of younger breakaway brokers that have reasonable assets, $1 billion, $2 billion assets. I think they've started their own firms, and now they're the ones that are really sort of leading and getting bought out by private equity. But I just don't, in this industry, you can't start an investment firm and expect to get out in 5 years. I mean, or it's just not going to be successful. You're going to want to take too much while it's there. Your assets aren't going to be large enough to get out in 5 years. You have to sort of do it for the duration. And if you do it for 16 years like we have, after finally making it, I don't know why you'd ever get out. But some of the numbers that are being thrown around in the multiples are extraordinary that people are getting for some of these firms. So
yeah. Yeah, it's crazy how bullish people can get in finance and the multiples that people are, and you wonder, go, it's like, how can they afford to do that, right? And
Right.
I think that there's some companies that look at it as like, okay, well, we're going to offer this 20 multiple, right? But it's really going to be a 13 or 14 because we're going to eliminate half the staff or whatever.
And then also, the way they structure it is they structure it with, first of all, they make you feel guilty for not taking part of the new entity, right? So they don't give you, like, they want you, whatever the new entity is, they're not going to trade in your company stock for the new entity stock. So now you're not getting paid out. Then they make a big portion on the back end. So if you take a deal in the beginning of 2020, and COVID hits, the revenue goes down. If assets and performance go down just because the stock market or the fixed income market go down in a long period of time, the back end deal can go away.
Right.
And so you have shares of this new company. Now you got to wait until this new company has liquidity. And I don't know, it's not as pretty as it's advertised sometimes.
Yeah, I agree.
And so, John, you mentioned how there's the 3 partners who started this. You guys have 10 employees total, figuring out that succession planning there, that G2. How do you motivate and inspire your team during challenging times in the business?
Yeah, well, I think a lot of that is the people that you sort of go to war with and how you structure it. I'm more of a example type of person, but we've created a culture here in a small business that's we have tremendous work-life balance. I believe our people have a lot of time to spend with their families, but they also understand the core message that our client is the most important thing. And sometimes clients don't have a problem at 2:00 in the afternoon on a Wednesday. Sometimes they have it at 7:00 in the evening on a Friday. And
Right.
So they understand to stop what they're doing, and because that reaction to the client's needs is number one, and that's the most important thing for us. And so, and I think the other thing that helps to lead by example, which means not working alone with people, is we've hired very strong people in each of the functional areas. So back office operations, trading, compliance, client service. We've hired senior people in each of those roles, as opposed to starting it from scratch and trying to train them up. People that have 10, 15 years of experience in each of those. So it makes that burden a lot less. From a sales perspective, what we're finding is it's a lot easier to hire someone younger and train them to what we do, as opposed to trying to get broker to come in because they think that they know how to do things, and they probably do know how to do things from that perspective, but they're not going to embrace what we do from an asset allocation perspective. They're going to want to get paid, and I think what we do is simple if you don't have all these preconceived notions and can be trained from the ground up. So that's been successful for us. So having functional leaders in each of those areas really helps to do things without having to hire too many headcount, and then also allowing technology to do the work for you. So when we got started, we implemented, we have multiple Bloombergs, which you don't normally see an advisory from. We have 10 that we use for back office operations and our trading platform. Custodian agnostic. We don't need you to go to Schwab or to go to the old TD or to Pershing. We can use Bank of America in New York. We can use State Street. We can, infrastructure like that allows us to do trades across thousands of accounts with the push of a button. So all of those things actually cost money, and that's why we have to have a long-term focus. The 3 partners that we talk about through COVID, through the initial time period, we've implemented an expensive infrastructure. We've hired quality people, and then when the equity market goes down 30%, your revenues are going to hurt. And there's no 2 ways about it. And we have to make those sacrifices during that time period because the average employee isn't in this for an entrepreneurial venture and something to get out of it 30 years from now. So you have to make them stable, and we take the bullets when we need to. But then eventually we get the upside as well.
Yeah, and you talked a little bit about technology there. Let's talk a little bit about AI. You know, it's transforming many industries. How do you see AI impacting the investment management sector? Are you guys utilizing AI at all? Tell us your thoughts on that.
Yeah, I think where AI is going to make the biggest impact is in the institutional marketplace. I think um, banks, large investment organizations are brilliant at packaging things like AI, uh, things like CDOs, things like CLOs in fancy, packages that then they're going to productize and sell both to the institutional and, quite frankly, to the retail marketplace and the high net worth marketplace. So I think it's going to cause a proliferation of algorithmic hedge funds and leverage arbitrage strategies and all these things that have AI as the backdrop. But we're not using it at all because I still don't know how AI is going to tell me if the Fed's going to raise rates or lower interest rates, if inflation is going to be a problem, continued problem going forward, what growth forecasts, what unemployment is going to be. And even if they could tell me what that is, it's almost impossible to tell me what the impact of the market is, right? So for the last year, bad numbers have been good for the stock market. And now, in August, bad numbers were bad for the stock market. And now, the Fed coming in and saying, we need to pivot here, we need to start lowering interest rates. Well, that means things are bad, but the market is going up. So from a high net worth standpoint, I don't think, it's sort of like the advent of the robo-advisor, where you don't pay a lot, but you get a 1-800 number and you get 5 mutual funds in your portfolio. People want, advisors and, to know if they should refinance their mortgage, if they should get a home equity line of credit. These sort of questions people want answers to. So we positioned ourselves as slightly higher fee than the robo-advisor, but all of the advice and all of the information that a typical advisor would give you. And I do think on an operational standpoint, things that are nuts and bolts, I think artificial intelligence will help leverage efficiencies in the asset management world from the back office to the middle office.
Thank you. And let me ask this, what do you think about the economic outlook, right? There's been so many changes that have gone on since COVID with interest rates. And could you elaborate on that more? And what do you think, do you think the market looks frothy? Or feels frothy at the moment?
Well, the market always seems frothy when you're at the top. I think we're going to, over the next number of months, experience a lot of volatility. I just think that's the bottom line. And we've reached this period where we were 25, 30 years ago, where we have higher interest rates and we have actual market cycles. We have actual interest rate cycles. And a lot of people that are managing money today haven't really seen that. The Fed actually lowering interest rates is a novel concept because we were at zero for so long. So I think, and that was true then, I think it's going to be true now, which is the Fed is going to determine what happens from here. They're going to be the primary component of this. It's clear, and back then, the Fed always kept rates too high and they always kept them for too long. It's because they're always working off of data or economic data. And, the 800,000 job revision is just one indication of that. And I think they're behind. And so they talked about pivoting, which is good. The degree to which I think we will get into a recession, the recession's not that scary word, it's just 2 negative GDP quarters. But the degree to which the recession will go into is how quickly the Fed is going to react. If the Fed does 25 in September, is afraid of the elections, and does another 25 in December, I think that we could start slowing down a lot more quickly than we need to. I think they should actually do 50 in September and then another 25 in December. But they sort of, following the data, which is what you do as a fixed income manager, following the impact on the interest rate cycle and how that's going to impact everything. So I think we're slowing down, and I think that's going to continue to happen. And the degree to which we slow down is going to be how quickly the Fed reacts, but at least the Fed has room to react now, which is a positive.
Gotcha. Thank you. I
Yeah.
appreciate that.
Interesting times ahead for sure. Well, thank you so much, Jonathan, for joining us on the show and sharing your insights and your wealth of knowledge, not only with us, but with our audience.
Thank you. I appreciate being here.
It's been a pleasure. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Stay tuned for more thought-provoking conversations ahead. Until next time, take care. Thanks, everyone.